This week we're in Chapter 5 where we're going to talk about profit, profitability, and break-even analysis itself. In Chapter 4 we looked at analyzing financial statements, and in Chapter 5 we're going to look a little deeper into that to explore methods for methods that we can use to plan a financial strategy. To start off, we're going to kind of cover some definitions and some terms, and again, all of this is covered in the textbook itself. But the first definition that you should understand, the difference between the two, is the difference between efficiency and effectiveness. And efficiency is obtaining the highest possible return with the minimum use of resources, while effectiveness, on the other hand, is really just talks about accomplishing a specific task or reaching a goal. Let me just give you an example of efficiency. It takes a lot more energy, a lot more gas, a lot more engine to get a car moving from a dead stop to 10 miles an hour than it does to get a car moving from 50 miles an hour to 60 miles an hour. It is much more efficient. But both of them are effective in increasing the miles per hour of a car by 10 miles per hour. If you were to ask your kids to mow the lawn on two weekends, and they both mowed the lawn, but it took one of your kids only an hour to mow the lawn, and it took the other child 2 hours to mow the lawn, you would say they were both effective because they both got the lawn mowed. But obviously, one of them was much more efficient at mowing the lawn than the other child was. A great example of the difference here between efficiency and effectiveness is really just the invention of the assembly line itself. When Henry Ford put into practice the assembly line for assembling automobiles, they were still very effective, just as they were before in getting an automobile built, but it became much more efficient by introducing the whole concept of assembly lines themselves. Now, sometimes closely related to this is the concept of profit and profitability, and we sometimes have a tendency to put those two efficiency and effectiveness we think is synonymous with profit and profitability, but it really isn't. Profit is an absolute number. It is just a number that is earned on an investment. There's two kinds of profits out there. One of them is called accounting profit. That just shows the bottom line income statement, net earnings, net profit. All of those things are synonymous terms. There's also a concept called entrepreneurial profit, which you will hear sometimes, but not very often. It is really the amount that is earned above and beyond what the entrepreneur would have earned if he or she had chosen to invest time and money in some other enterprise. And this is really just kind of a term that especially those who are in the entrepreneurial world, and especially when they're in the startup phase, they'll refer to that. It's a concept that really harkens back to opportunity cost, which we talked about in an earlier chapter. Let's say that you had a job that paid $25,000 a year, and you decide to quit that job to pursue kind of a hobby, a passion that you have of making cakes. And so you quit your $25,000 a year job, and you're making cakes job that you now are doing. You make $10,000 in your first year selling those cakes. Well, your accounting profit obviously is the $10,000. But the entrepreneurial profit, or in this case, the entrepreneurial loss, which is the opportunity cost of pursuing this particular endeavor, is $15,000 lost per year. The difference between what you could have made at $25,000 at your other job versus the $10,000 that you actually made this year in pursuing your dream itself. And that's taken into account. That's the opportunity cost that created, in this example, an entrepreneurial profit. So profitability in a company is really is just what we've referred to last chapter of the return on investment or return on net assets itself. It can be stated as a ratio itself. It's the net profit, net income divided by what your average total assets are. And remember, average total assets are your beginning of period assets and your end of year assets, and what the average is between your two. And this profitability or return ratio is related to the efficiency of how you're using your assets, much more than just the effectiveness of using your assets. Closely related to this is a concept called earning power. Earning power of a company can be defined as the product of two factors. It's the company's ability to generate income on the amount of revenue it receives, also known as net profit margin, and its ability to maximize sales revenue from proper asset deployment, also known as total asset turnover. So in other words, it is bringing in the concepts of both efficiency and effectiveness itself. So let's look at earning power formulas. Now, just as it was in the last chapter, you can get so hung up where you cannot see the forest for the trees in all of the details of these formulas. And all these are just algebraic representations of concepts that you want to understand. Earning power itself is equal to net profit margin multiplied by your total asset turnover, which is that asset turnover is equal to the return on investment that we talked about before. So really, this ROI itself is earning power. In chapter 4, we talked about how you read about how low inventory turnover, that if a company has low inventory turnover, it must compensate for that low inventory turnover by having a high profit margin. For example, you ever wonder how jewelry companies in malls stayed in business? Because you don't necessarily always see a whole lot of customers in there or a whole lot of customers buying things. Well, they have a very low inventory turnover, but they have a very high profit margin associated with this, with their inventory. So that's how they make up the difference in their earning power. On the opposite end of that is someplace like a supermarket, which has very high inventory turnover, but they have low profit margins. So how do they still generate earning power? Well, they generate earning power by maintaining those ratios itself. So when we talk about breaking even in sales, we talk about the ability to still generate those operating margins and compensating for what our turnover is by our operating margin per unit is itself. Let's use an example here. Because now I want to talk about conceptually about break even, and again, you can get so caught up in the formulas that you don't get the concept itself. So let's just pretend that we now have our cake business that we are undertaking, and we're able to sell each of these cakes for $15 a cake. These are gourmet cakes, and but it costs us $5 to make the cake, the cost of the products and the materials and everything else itself. So you look at that and you say, okay, if it costs me $5 to make the cake and I'm selling it for $15, I have a profit margin, an operating margin on that of $10 per cake. Now let's just conceptually say, okay, I'm making $10 a cake, just basic itself, and I want to pay myself $100 a week in salary. You sit there and you say, I don't have any other expenses other than the cost of making the cake and my salary of $100 that I want to take out of the business. How many cakes do I have to sell to be able to cover paying myself $100 a week? Well, obviously, if a profit margin per cake is $10 per cake, you have to sell 10 cakes to be able to cover paying yourself a salary of $10 a cake, or $100 for that week. So let's look at just mathematically how that is, it breaks out itself. Break-even analysis is a process of determining how many units of production must be sold or how much revenue must be obtained before we begin to earn a profit. And as you can see here algebraically, it's presented this way, where the break-even quantity, BEQ, equals the fixed cost divided by the differential between the price per unit reduced by the variable cost per unit. So let's just use our example that we just talked about. Is if the fixed cost was $100, because that's the salary that we wanted to take, and we look at it and say, okay, our price charge per unit is $15 per cake minus the cost of that cake of $5. That means that the denominator is $10. So the fixed cost of $100 divided by the contribution per cake of $10 equals the break-even quantity of 10 cakes that we have to sell. That seems relatively simple conceptually, but let's just look at how we can use that to really talk about break-even dollars itself. Because break-even dollars itself for a retail firm, and let me kind of get through the talking through all the advancing of that, is for a retail firm, you say, okay, well, obviously on the per unit basis, it's not quite as simple, but you can look at it and say everything can be broken down to a percentage. So let's take our example that we're talking about, that we sell cakes. On the numerator, the fixed cost is going to be $100 in salary that we want to cover. Our cost of goods sold, our denominator, is obviously it costs us $5 per cake divided by our net sales of $15, and that's going to give us a profit margin of 0.67. So as we look at that, we can start to realize that we need to sell a certain dollar amount to be able to cover that. And we can see how this break-even analysis works. And we're going to, I'll kind of show you an actual example here in just a minute. The contribution margin is the amount of profit that will be made by a company on each unit that is sold above and beyond the break-even quantity. And the contribution margin is also the amount the company will lose for each unit of production by which it falls short of the break-even point. So you look at our example and you say, well, the break-even is we have to sell 10 cakes a week to be able to, in essence, have that break-even of paying us a salary of $100 a week. So so if we sell less than 10 cakes, we're going to have a loss. If we sell more than 10 cakes, we're going to contribute a profit itself. So let's look at how this break-even analysis just works itself. So using our simple little example. So the quantity itself is, we already went through and said, okay, the break-even is 10 cakes itself. But let's say we wanted to put into place a business plan that said, well, not only do I want to have $100 of salary, but I also want to have $50 of profit, because I want to start building net equity into my business to be able to expand my business later. So how many do I need to sell? What kind of sales do I need to do to be able to achieve that? So the formula itself becomes relatively simple. Let's look at the quantity items itself first. Is we already know that we need to sell 10 cakes a week to break even with respect to paying ourselves a salary of $100. But let's say that we wanted to not only have a salary of $100, which is our fixed cost, but we also wanted to have a profit of $50 that was going to be showing up beyond that. So our numerator becomes 150, 100 plus 50. Our denominator, again, is we're still selling the cakes at $15 a piece. They still cost us $5 to produce, which means that we still have a $10 profit margin or contribution margin per cake. So we have $150 in the numerator divided by $10 in the denominator. That tells us that we need to have, the answer is 15. We need to sell 15 cakes a week to be able to cover our salary of $100 and to have that profit of $50. That is our desire. So what does that then, we can also kind of back into that is, say, well, what kind of sales is that per week? Well, if you look at the formula itself, is again, you have fixed cost of $100 for your salary, desired profit for 50. You are converting your denominator to a percentage itself, and the percentage itself is 0.67, and that represents, in essence, the how much your profit margin is on every cake that you're selling. It's 10 divided by 15. 10 being your profit itself divided by 15 as to what you're actually selling. So you take your denominator of 0.67 and you're dividing that into your numerator of $150. That means you have to have per week $225 of sales, which is 15 cakes. In essence, you have to have 220, well, it's more than 15 cakes, but $225 of sales per week to get that desired break even that you are going for. Graphically, we can represent it this way, that you just understand of what you are trying to do is you look at here and say, you are trying to identify a particular break even point where where you are then covering whatever your costs are that you have set forth. And you can see the total cost line there is your fixed costs plus your variable costs. And again, this is assuming everything else is equal itself, that is actually graphically a straight line. And you can see what your total revenue is, and there's always a certain point in time that when your revenues get above a certain amount, you start to make a greater and greater profit. And when your revenues are below, you start to have a greater and greater loss. And your break-even point is you want to understand where those lines cross, and you're going to be driving, in essence, your sales higher and still trying to manage or control your fixed costs and your variable costs itself. Now, there's a concept called leverage out there, which really that uses these items graphically that we have graphically depicted here to really calculate what those items that have a fixed cost, what the return to the company is. And those fixed costs can be related to a company's operations, or it can be related to decisions as to how you're going to finance that company, whether it's going to be debt or equity. And as you look at these things, interest expenses that you incur are going to be paid on the amount of debt that is going to be incurred, which is the fixed cost of financing. And a firm that is heavily financial leveraged means that it has a high fixed cost of financing. So these things really allow you to come into play where you're making business decisions of fixed versus variable costs, and how you are going to, in essence, run and make planning decisions with respect to certain items. For example, let's take the example of a Walmart. That a Walmart can make a decision that is going to hire more checkout people that are at an hourly basis, and that they're only going to bring in the checkout people when they need them for certain business peaks, certain seasonal highs. They can make a decision that no, these checkout people are going to be a completely variable cost, or we can hire these checkout people to be full-time employees. They're going to be there 40 hours a week, regardless of what the push through is at the checkout stand itself. And so they're going to make certain decisions with respect to that. And the break even is obviously going to be sooner for Walmart if they have more of those checkout people are variable people, because they're making a decision with respect to managing those costs. However, for those internal type of decisions, which are called equity decisions, they have less losses if they don't achieve what their break-even sales are, but they also have less profit margins associated with that. So they are going to be making those kind of business decisions of bringing people in associated with that, which really is an operating type decision. However, let's say they wanted to lower their operating costs, lower their labor costs, by making some upfront decisions to bring in more self-checkout counters. Now, we know those self-checkout counters are expensive to put into place initially. And usually, if you walk into a Walmart, there's only one labor person for every 4 self-checkout counters. So they make a decision to, in essence, buy 4 of those machines up front, whether it's through internal capital or go out and borrow the machines through leasing or debt financing. And what they find is that the way they're leveraging that decision is that they will have more losses if they don't reach their break-even sales numbers, because the initial cost of these machines are much higher, and these costs of these machines become a fixed cost versus a variable cost. But as their sales increase, they start to have greater profit margins because they're leveraging the cost of those machines much greater than leveraging what would have been if they just brought in additional labor. So how does this actually work arithmetically? Well, there's a ratio out there, a formula for degree of operating leverage, which is the percentage change in operating income divided by the percentage change in sales. And we're going to be looking at this in conjunction with another ratio out there. This really allows you to zero in on how efficient you are being with your balance sheet itself, and the upper part of your balance sheet, looking especially at your asset, because you're able to look at the efficiency of your fixed costs, things like leases and rents and depreciation, salaries of management personnel, and you're really zeroing in on your percentage change in operating income. Now, remember, operating income is what's also referred to as EBIT. It's earnings before interest and taxes. And so you're looking at that component as how it's changed over the period, whether it's a month or a quarter or a year, in relationship to the percentage change itself. So when you look at this as to this relationship itself, you're really able to evaluate the use of your assets in your upper half of your balance sheet or your left side of your balance sheet, depending on how you're presenting it. Conversely, you also have what's called a degree of financial leverage, which is the percentage change in earnings per share divided by the percentage change in operating income. So now what you are doing is you are taking that line item of operating income, which is earnings before interest and taxes, and you're comparing that now down to your bottom line, which is after interest and taxes. And this is telling you, just allowing you to evaluate your business based upon financing decisions you have made, the degree of debt that you've got in relationship to the degree of equity that you've got. And so again, you look at that and you begin to understand how efficient you are being in leveraging your debt decisions. This really brings us to the combining of this, which is your degree of combined leverage, your DCL, which is the percentage change in earnings per share divided by the percentage change in sales. So if you look at these things, you just see that, again, you're combining the numerators and the denominators. And what this ratio basically tells you is generally, with everything else being equal, the higher the debt you have, the higher of the DCL you're going to have. And it allows you really to manage your debt to be able to maximize your debt burden, because as you can just conceptually understand, debt, being able to leverage your debt can be good up to a point. And then you start to have too much debt, and your debt in essence begins to drive too much interest expense to your bottom line, which then starts to bring down your DCL itself. So again, all of these things, just like the ratios we looked at in the last chapter, all of these things can kind of be looked at together to get a total picture of just the efficiency and not just the effectiveness, but the efficiency of your business decisions itself. I want to briefly mention, because the chapter brings this up also, is just talking about bankruptcy and the concept of bankruptcy. And bankruptcy occurs for a business when the liabilities of the firm exceed the assets and the business does not have sufficient cash flow to make payments to creditors. And there are really essentially three kinds of bankruptcy that are out there. Chapter 11 and Chapter 7 are well known. Chapter 13 maybe is not quite as familiar to you. Just the difference between these three bankruptcy provisions. Chapter 11 occurs when a business seeks court protection while it develops a reorganization plan. Sometimes you will hear this as a bankruptcy reorganization. And what this is this the bank or the court kind of tells the creditors to, okay, stop right now, while management seeks to come up with a new plan as to how it's going to go into the future. And so a creditor who is breaking down your doors, creditors who are seeking to try to drive you into fulfilling the debt obligations, and it's forcing you to close your doors if you try to do that, the court steps in and puts in essence a hold on that while you come up with a new plan of reorganization. And this plan of reorganization, which usually is a comprehensive plan with respect to refinancing, it's a comprehensive plan as with respect to marketing strategies and relooking at how you are going to really rebuild the business from the ground up. Quite often, as part of that plan, you also are then offering to meet your debt obligations for a certain percentage less than what you have out there. For example, it may be that you're willing to pay 50 cents on the dollar for those liabilities itself. Any reorganization plan has to be approved by a majority of the creditors. And it's not just the majority of the number of creditors out there, but it's representing usually 2/3 of the liabilities that are owed. So again, it's a rather dramatic. It can mess up your credit ratings. It really puts you at a disadvantage, but it does allow the business to, in essence, get back on its feet and rebuild value into the business itself. Chapter 13, bankruptcy, is just basically a Chapter 11 with much simpler provisions, but it's reserved solely for those who are sole proprietorships and individuals. Chapter 7 is that's kind of the end of the line. That's referring to the actual liquidation of the company itself and how that liquidation of those assets of the company is going to then be used to subsequently pay off whatever the creditors are able to get. And usually creditors then are going to be getting a rather low percentage, 10 cents on the dollar or something like that if a company is forced to go through Chapter 7 itself. Just one thing I want to say is this, in and of itself, when you're going into a startup of a business or you're in that entrepreneurial mode of the business, do not be thinking about bankruptcy as a viable business strategy. This is one of those things that you really need to be thinking of as a last resort type of strategy to be employed. It used to be that there was a lot of abuse in bankruptcies, especially in real estate investment type things, where they would take very risky moves and decisions, and just in their minds, as part of it was, hey, we're going to go out and build value into this, and if push comes to shove, we'll just declare some sort of bankruptcy and let somebody else eat the risk and the losses from this high risky decisions. And there have been a number of laws that have been put into place to try to limit that kind of abuse of the system out there. Many of these were signed in by President Bush back in 2005 itself. And so it's just important to understand what those provisions are and what those terms are. Until next time.